Hello and welcome to this course on financial frauds. Now we are going to discuss the third method of financial fraud, which is concealing the liability and reducing the expenses. What happens in this method is that we are trying to conceal our liabilities. Basically, we are trying to suppress the expenses to improve the profitability. So in this example, in this case, usually the liabilities are omitted, means the expenses are omitted because liabilities you will incur only for the expenses. So it may be interest, it may be the expenses, it may be legal costs, it can be the other research and development expenses which are omitted. Other method of this is to capitalize the expense. So means certain research and development expenses can be capitalized. Certain other expenses can be classified as pre-opening expenses. Certain expenses can be classified as certain repair maintenance expenses can be classified as the fixed assets, which is going to be amortized over a different period of time. So and then also sometimes you may fail to disclose the warranty cost or the other liabilities. Maybe you are selling a machinery which comes with a cost of 12-month warranty service. So normally the accounting standards require you to split the revenue between the sale and the warranty liability. Warranty liability will be recorded as a liability. So instead of showing splitting the transaction and showing the liabilities and the revenue separately, you are combining the revenue and without showing any liability towards the warranty cost. So that is again happen when you normally there are service companies. They are asking the 3-year subscription, 4-year subscription in advance, or sometimes they are saying you buy the product from us, you will get a lifetime warranty. So what is the lifetime warranty? There is a cost to service the product, right? So normally the accounting standard would ask the company to split the revenue, which is going to be this year, means the real sale, and the amount which is sufficient to cover the warranty cost in the future. So 2 years later, 3 years later, 4 years later, how much money you have to set aside to be able to cover the warranty cost. Otherwise, your matching principle will not happen, because which case usually you will recognize the revenue in this year, but the expenses to service the warranty which you have given in the past will come in this year, right? And or come in another period. So the profitability of those period will be reduced and profitability of this period has increased. So that's why normally the businesses, the auditors or the financial analysts will really try to understand the nature of the business, the nature of the warranty guarantee that the company has offered, the service contracts the company has offered, how much lifetime warranty are there, what is the future liabilities of the company to service those warranty or guarantees, and also whether the certain expenses has been recognized as an asset. So this let's say recognizing the capitalized the expenses will have both impact. It's inflating the valuation of the assets, also reducing the expenses on the other side, but putting them into the depreciation. So in this case, you may be easily increasing the profitability of the company. Now this usually happens. So the auditors normally are going to go with the physical asset and challenging the expenses which are put into the capitalized, especially the repair maintenance cost, especially the warranty cost, the servicing, overhauling, changing of spare parts, whether this should be go to the capitalized, there should be go to the expenses. Normally there is a quite a bit of discussion or quite a bit of conflict, and there is a subjective understanding. Another way to hide the expenses or to capitalize the expenses is, let's say for example, you are buying a machinery, right? You may have taken a loan to fund the machinery. Normally the capitalization, the borrowing cost capitalization standard requires that if the asset takes time in commissioning, then only you can amortize the capitalize the borrowing cost. But the management may argue with the auditors that since they have borrowed the money and they have used the money to buy a fixed asset, they want to capitalize the borrowing cost for that particular asset, which is not really as per the standard. But it depends on how the management may convince, or the materiality of the transaction. The auditor may ignore it or maybe not able to check it properly. That there is what is the in the cost of the capitalization, what they have added. Well, they have added only the cost of purchase. Maybe they have added the taxes. Maybe they have added for which the company can get the advance the fund for those taxes. Maybe the company is, when they are buying a asset, they are entitled to get certain subsidies in the import duties or into the excise duty or the taxes, which they are not using from the capital asset, but putting the capital asset as full and putting the refunds into the revenues or reducing the expenses. That may also happen, which will again increase the profitability, but will not be the real financial statements presentation. So those are the method of concealing the liabilities and also reducing the expenses.